All right. Joining me is Bill Birmingham, Managing Director at Osprey Funds, who's a crypto focused asset manager offering a number of publicly traded funds and ETFs. And Bill himself is responsible for helping to design and launch those products, which, of course, as part of that, Bill obviously stays very attuned to everything going on within the crypto markets themselves, which is where we will be focusing our attention. And so, Bill, it's great to see you. Thanks for joining me.
Thank you for having me. Good to see you again.
Okay, so we are going to dive fairly deeply into the crypto markets, but I thought before we do that, do you want to offer a quick introduction to Osprey Funds and also the Rex Osprey ETFs? And perhaps you can explain the relationship between Osprey and Rex shares, again, for people who are unfamiliar.
Sure, absolutely. So Osprey is a sub-brand of Rex Financial. Rex Financial is an ETF issuer that focuses mainly on levered products, as well as a burgeoning suite of growth and income funds. And we also are starting to launch some interesting thematic products as well. But Osprey kind of fits in that thematic bucket as a crypto native digital asset manager. We were formed in 2018 as kind of a way to really highlight crypto in a specific brand. It's still part of the Rex family, and we do a lot of our work in kind of a shared environment, using JV structures. But we like to have the kind of differentiation of the Osprey brand on top of our crypto products, given just how unique and burgeoning the space is.
Yeah, and just to give people an idea, if I look at the crypto focus offerings from Rex Osprey, there's a Sol plus staking ETF, there's an XRP ETF, a Doge ETF, there's a ETH plus staking ETF, and then there's also just a standalone spot Bitcoin ETF. And I don't want to get too far in the weeds here because, again, I want to focus on the crypto markets. But I know one of the key differences with a number of those Rex Osprey ETFs and other spot crypto ETFs on the market is that you're using the 1940 Act structure. Do you want to explain that and what that means for investors as they look at the various crypto offerings that are out there?
Sure. So a 40 Act fund is a registered investment company, and what it allows us to do is offer investors a couple key benefits compared to competitive products that use 33 Act structures. And not to get too deep in the weeds on securities law, but 40 Act is a way to give people heightened investor protections. Most importantly, they don't get a K1. Their tax reporting is very simplified in terms of a 1099. And it allows us to do some innovative things inside the product. In addition to tracking crypto, we also are able to, like you mentioned, generate staking yield and offer that to investors, which is a very unique feature. And it's a very crypto native feature. Staking is a fundamental aspect of proof of stake blockchain protocols, and the ability to participate in that security function and then distribute the benefits of that security function, which is the yield that you generate for staking your tokens, is is a really, I think, innovative feature that we bring to the market.
And then, as I understand it, Rex Osprey also has some crypto index funds in the hopper with the SEC. Is that correct? I don't know how much you can comment on those, given those are live filings, but there's some additional products that will be forthcoming. Correct?
They are filed. We are in active development on these funds. Like you say, I can't say too much more on them, but we're very excited about the concept of indexing in the crypto space. I think we can get into this a little bit later in the conversation, but we're big believers that crypto has reached a point where what we call it is the fifth asset class. In which case, then institutional investors will be looking to get asset level returns to crypto, and we think the best way to generate asset level returns is through index products that essentially solve a lot of the balancing and weighting problems in a 40 Act wrapper that institutions are looking for.
Okay, so that's Osprey Funds and Rex Osprey ETFs. Let's talk crypto markets. And I guess to start, I know that you were at Blockworks Digital Asset Summit in New York last week. Just out of curiosity, any big takeaways there? Any big topics of conversation that stood out to you? Maybe that'll get us down the path to some other topics there.
Yeah, absolutely. It is a very good conference in the crypto space to get the pulse of where the market is moving, especially with relation to kind of the finance community. It's held in New York. It's a very well-run conference. It's been around for a while. It tends to really create a nexus between crypto native projects and the New York finance community. This year it tends to be a button-up event, but this year in particular, it felt a lot more narrow in terms of discussing crypto for institutional workflows. One of the phrases I heard kind of thrown around a lot was less debate, more execution. So there seemed to be a real serious focus on integrating more crypto tools in the market, and that's kind of a good segue into a few of the kind of themes that I saw emerging there. I mean, we could start wherever you want, but I'll throw out stable coins as payment infrastructure, kind of as the first major one that was a heavily focused on topic. Western Union was there. They presented just the talk around using stable coins, less as collateral and more as institutional payment rails was a big topic of conversation. So that was a good place to start.
When you mentioned the conference being a little more buttoned up, is that more that it's morphed into more TradFi? And I guess if so, is that just a reflection of crypto moving more that direction overall?
I think it's a function of some of the larger financial institutions integrating crypto rails into their database and other payment structures. I think before, if you would have looked at this conference or any other crypto conference, it would be a lot about what any new layer one protocol was doing to solve a particular problem in the financial markets or in the kind of finance community in general. And now you think you're starting to see some coalescence around, core crypto backbones, whether it's Ethereum, some of their layer twos, or Solana, or some of the emerging stuff we can talk about in a moment, being much more integral into just existing finance workflows. So it was less about what's coming next, more about how are we using what exists now.
Okay, and so what were some of the other themes there? So stable coins,
So
infrastructure, what else?
another big theme would be tokenization. Franklin Templeton, a major asset manager with over $1 trillion in assets, announced a partnership with Ondo, which is a crypto native tokenization platform. Starting the process to tokenize their various fund offerings. And tokenization has been a topic of conversation for a while. I know a few other firms have gone down this road. It's been difficult to do simply because the regulatory environment puts an extra layer of kind of friction on top of tokenized assets that require you to be accredited. You have to trade them inside a walled garden. It's very hard to bootstrap liquidity when you're adding friction as opposed to taking it away. But what was unique about this particular moment was the fact that it dovetails with probably the next theme, which is regulatory clarity. And as kind of regulatory clarity starts to emerge, then tokenization becomes a much more realistic and feasible project for major firms. And so I think the Franklin Ondo announcement was significant in that it kind of brings them to the starting line and sets them up and others up for what is probably going to be a much faster implementation of tokenization over the next couple of years. I think definitely stay tuned for that.
How was the overall mood at the event, just given the crypto downturn we're currently in? And clearly there's building going on, stablecoins, tokenization. You just mentioned the regulatory backdrop, which there's obviously still work to do, but I think it's progressing in the right direction. But at the same time, all of that is occurring. We've seen substantial pressure across the crypto space. So what was the mood like with that as the backdrop?
It's funny you say that you reference the crypto downturn, because if you were just to drop into this environment, not knowing, the charts, you would definitely come away with a much more optimistic view of the asset class at the moment. Paul Atkins putting out his 5 categories of SEC taxonomy for, classifying tokens was probably one of the most bullish events that's happened, in a number of years. It definitely set the stage for many projects to start to look seriously at how they're going to move forward in the United States given this given this progress. I mean, obviously Congress still has to act. There's a ways to go on it, but just the simple fact that the SEC is at this event, with the highest leadership and putting out details as to compliance is very bullish. And of course, if you're focusing on implementation, plumbing, real world use cases, then you're definitely looking forward and not as concerned about price action. And I guess it's also worth mentioning probably two other areas in this space that were also very interesting and are kind of hot topics in the crypto community. And one of first is privacy. Privacy is an extremely important element to any type of financial system. People don't want their collateral positions being disclosed on chain. You certainly don't want your accounts to be fully visible to other parties in the market. So what is starting to emerge in various forms, whether it's through Canton's kind of combined permissionless system, or you see it now through ZK proof projects that are trying to implement both Solana and Ethereum, is that privacy is becoming a serious concern, and that it's actually starting to get some real world solutions, which will allow for much bigger financial flows to come on chain. And then the second major thing that is exciting everyone is the concept of perpetuals. And perpetuals are just a new form of futures contract that is on chain right now using a protocol called Hyperliquid. It's not available in the United States, but amazingly, it is generating tremendous amount of speculative interest offshore. And you are seeing real world assets being traded in perpetual form on this platform, whether it's oil, whether it's gold, whether it's tokenized equities. It's a very, very interesting space to watch. And just to kind of give you a quick primer on what they are essentially futures contracts that never expire. So you're basically constantly exposed to the market. You post margin and you're able to get leverage. The side that is above spot pays the other side. So it's really interesting, unique, kind of crypto native only, way to get levered exposure on the future. And I think it's just another example of how crypto brings a lot of innovation to the financial market.
So, Bill, as you go through those themes there and you talk about the innovation and the building, and I sense a lot of optimism from you, how do you reconcile that with the recent crypto downturn we've seen? And if we look since early October, you know all the numbers here. Bitcoin is down about 45%. Ether and XRP are down around 55%. Solana is down nearly 65%. I could keep going with other assets, but again, you get the idea. There's been a lot of pressure in the space here recently. How do you reconcile that with the building that's going on behind the scenes? Do you just view this as a short-term blip, and are there any key drivers of that short-term blip?
I think it's worth zooming back a bit to that kind of October high and putting a bit of context around this to I think it's level set the downturn. First of all, if we go back to October, the reason I think that Bitcoin had reached 125K and that other assets had run into that environment is that you were just seeing a very aggressive positioning on the theme of the debasement trade. I think a lot of people were looking at kind of fiscal deficits. You were starting to see a lot of interest rates move in Japan. There was just a very kind of consistent theme going into that world of whether or not fiscal dominance was going to be, a big part of our lives going forward. And I think Bitcoin is a way to play on that theme, as are, metals and stuff, which is an interesting segue into gold. But that, and then you also had a situation where Bitcoin really lends itself to a concept called basis trading, which is essentially buying the spot and selling the future and waiting for those two things to converge and capturing the time spread. And basis trading in Bitcoin is can be very lucrative, but it's also just very high frequency. You have offshore exchanges that are centralized that allow this type of trading. You have obviously the regulated exchanges in the United States. People use ETFs. Then you have these decentralized exchanges that have open interest that allows you to basis trade. And into that particular moment, basis trading, there was a profitable basis trade that opened up into October. A lot of people crowded into it, and it kind of set the stage for the unwind when Trump announced his 1010 tariffs against China, which caught everyone by surprise. So, okay, crypto, Bitcoin, there's still highly volatile assets. I mean, no one's saying that they're not, they're not at this point. Um, but I would say that, under kind of previous regimes, if you had that kind of collapse, I would have said that Bitcoin would have gone down to 30,000. And you would have seen, the others probably shed as much as 80% of their value. And when, open interest friendly cleared out, you had a lot of institutional flows in ETF form, a couple $100 million in the weeks that Bitcoin bottomed, that, came in through ETFs. And it just goes to show you that there's a second tier of the market now that's developing in the institutional space that's looking at it with a much longer time lens. And they're saying, okay, we have price targets that are, significantly longer dated. And, in moments like this where, for whatever technical reason, the market crashes, maybe basis trading, got a lot of hand and it happens to go beyond our long-term trend, then we're going to step into the market. And I think that's a bullish sign for people who look at this asset class the way they should look at it, which is, very long duration, especially Bitcoin, infinite duration. And that I consider that kind of the bullish thing. So, okay, where do we stand now? We obviously have a lot of macro instability at the moment. One of the things that we look at are kind of the long-term on-chain metrics. And one of the interesting things that caught my eye the other day was that I think long-term holders now are 80% of the market in Bitcoin. And when it gets to about 85%, that tends to indicate a bottom. Though that also indicates that bottom takes a couple months to form. So, I think we have a sideways market from here. I don't see positioning getting too extreme in either direction. So it's just one or more of the things that you have to decide what your holding period is and whether or not this makes sense for you.
To your point on the volatility in Bitcoin and crypto, which has been well documented, it's funny. A few weeks ago, you and I were on stage together at the Exchange ETF conference in Vegas. And I'm sure you recall, I kicked off the discussion by polling the audience on how they view Bitcoin. Basically,
Mm-hmm.
whether they view Bitcoin as digital gold or more like a high beta tech stock. And we had Slido where people could respond in real time using their phones. I thought the results were pretty eye opening because 80% of the people in that room, which this was mostly financial advisors, 80% said they viewed Bitcoin more like a high beta tech stock. And I'm just curious, what did that say to you?
I think it says to me that there's still a lot of room for education in the space. I think that it's an interesting asset class in the sense that if you're in it, it tends to move at light speed, and so you can easily get carried away with a lot of the edge case innovation and all the things we just talked about coming out of DAS and all of that. But in the grander scheme of things, there's still a huge cohort of investors that still need to get their arms around just even the most fundamentals of crypto and what it does, and what the differentiation is between Bitcoin and say the other cryptos in the market. So I don't know. To me, that was definitely an eyebrow raiser as well. I was very surprised to see that. Now I was expecting it to be somewhere around the 50% range, but it just goes to show us that in the space, folks like myself have a lot of work to do to get people comfortable with the asset class, to understand it, to understand what it is, what it isn't, and how it can work for their clients.
And you mentioned obviously taking a much longer term view, whether we're talking Bitcoin or crypto in general, which I think that's good guidance for pretty much any asset class out there that an investor is going to allocate. But what could be some potential positive price catalyst for Bitcoin moving forward? Is it just the same story here that we're going to continue to have monetary debasement and Bitcoin is this longer term store of value? It is this longer term digital gold. How do you frame that to longer term investors in terms of what the opportunity is for Bitcoin?
Yeah, I think that argument is a good primary starting point, especially for Bitcoin. I mean, like I said, it's an infinite duration asset. The other day, I kind of, in preparation for this, I put down a little bit of a Venn diagram to kind of see where I thought Bitcoin, shared the space with gold and where the two of them were outside of the shared circle. And it was surprising to me how much shared space they had versus not. Obviously the immutability of it, the kind of worldwide recognition, being a kind of centralized form of money that is essentially recognized everywhere now, and just simply the fact that you're you're outside of the system. There are no counterparties. There's no offsetting liability. To either gold or Bitcoin make it, very much a store of value. And I think you said it well when you mentioned on stage that it's essentially a teenage gold in a lot of ways, and that it has a lot of maturation to do for people to integrate it. And then where it sits outside is that it's and this is a key difference though, is that it's internet based. Unlike physical gold, which can't be plugged very well into the system. We just talked about basis trading, and Bitcoin obviously being internet based money can plug itself into that system very easily um, to create more volatility than gold does, which tends to sit more in kind of sovereign funds. So I think it's important for investors though to understand that difference, to say, okay, I'm not buying a gold substitute. I'm buying something that has similarities to gold, but it has its own unique characteristics that in certain circumstances will perform better, in certain circumstances will perform worse. But in general, if you do honestly believe that we're in a longer term inflationary environment that is going to be driven by fiscal dominance, having an asset that sits outside the system, that is portable, that is internet based, that can be used as collateral in certain situations in your life is I think a prudent uh, way to think about Bitcoin, and an important allocation tool for a portfolio. So I do push back on the idea that it's a speculative tech stock. I don't think that Bitcoin is necessarily that. I think you can make that case, and we can have a debate about other parts of the crypto ecosystem. But I think Bitcoin kind of sits in its own realm with respect to what it does in a portfolio.
I didn't get a chance to see your Venn diagram of gold and Bitcoin, but I'm guessing one of the things that they didn't share, I know for a fact, one of the things they didn't share was on the risk side of the equation. And you mentioned obviously the internet when we're talking about Bitcoin. I have to imagine you saw this white paper that the Google quantum AI team recently published, where they basically said that quantum computing could be a threat to Bitcoin much faster than people are anticipating. And this has been something that's been talked about for a while, but essentially this paper laid out that the risk is more imminent than maybe what some people have thought. Is that something that you think Bitcoin investors should be worried about at all? And the other thing I'll say to that, Bill, is I have said before, and I'm a long term believer in Bitcoin, but if something can be created by humans, which Bitcoin was, and it can be destroyed by humans, whereas you can make the case gold wasn't created by humans and therefore it can't be destroyed. And so maybe that's a very important difference between the two. How do you think about that?
That's interesting. Yeah, no, that's a good point. Let's just focus on the quantum part first. Look, I will be the first to admit I am not a quantum scientist, so you can take my words with a grain of salt here, and I think people should definitely do their own research on this front. But being in the space, it's an important piece of the puzzle, and one of the kind of pieces of noise that emerged around that October time also that probably contributed a bit to the downdraft was this quantum debate starting to heat up. I know that Jeffries took Bitcoin off their focus list, which using that quantum argument, I think that's a bit overreactive and somewhat premature, but it's not real. And so just to kind of put some framing around this issue, um, so people understand, a Bitcoin key is the public key that is widely accessible, is a algorithmic creation of the private key. Okay, and then that algorithm works one way. It's essentially like you're putting the private key into a machine, and then the public key comes out the other side, and it can go one way, but you can't push it back the other way. And that is kind of the beauty of Bitcoin's encryption. Where quantum comes in is that quantum has the computing power, if real, to essentially push it through a different machine backwards that would generate the private key. I mean, that's a pretty spectacular form of brute force computing, but that is what would be happening. And so you could literally take someone's public key and then use a different algorithm with quantum compute to generate a private key, and then you would have access to that wallet. So, okay, what has to be true for that to happen? First of all, you have to have something called stable qubits in the quantum computing. And stable qubits do not exist at the moment. It's not clear that they'll ever exist. The current kind of quantum computing experiments are able to generate unstable qubits. I think all of us tend to believe in progress, in the technology space moves towards what's theoretically possible. And so I think a lot of people are just assuming that we will reach a stage where stable qubits are accessible and cheap enough that people will be able to use them in this context. I don't know if that's true or not. I don't know the time frame around it. Some people say within 10 years. Some people say it's much longer than that. So that's kind of issue number one. And issue number two, and what kind of caught everyone's attention this week, was the idea that you would need something like 100 stable qubits to essentially generate that kind of computing power to unlock the key. And then I think the Google research, as well as the Caltech folks, lowered that down dramatically to somewhere around 10 stable qubits, which, of course, is, a significant decline in power that, makes it just that much more accessible. So, yeah, is it a source of concern? It is. Everything's a source of concern. Investors should always be, cognizant of tail risks out there, and quantum is certainly a big tail risk. Now, okay, does that mean all hope is lost? I don't think so. On the other hand, there are ways to mitigate this. There's a lot of cryptographic research that is above my pay grade that could potentially be implemented to make the quantum threat just that much harder, almost impossible. So I think a lot of people are looking at ways to modify the network. And then here comes kind of the final punchline of this, which is, okay, if that's true, then why aren't the protocols doing it? And I think if you look at the various major crypto protocols, they're already kind of moving in this direction. So Ethereum has researchers working on this. Solana is certainly looking at solutions to being more cryptographically secure in the world of quantum. But Bitcoin being completely decentralized, I mean, there's no founding team of Bitcoin. There are no managers of Bitcoin. That requires a lot more kind of consensus governance to change that protocol. And what makes Bitcoin great is that it's hard to change. What makes Bitcoin somewhat vulnerable is hard to change. So, you have wallets. The original Satoshi wallet is a dormant wallet. It's significant. You have wallets that would be exposed because if they don't change with the group, then they may not get the upgrade. So this is all a very early stage concern that I don't think should necessarily change people's opinion about the asset class. But I did say you should look at this from a infinite duration, long-term perspective. And if to be consistent with that position, then you should also be doing your research on quantum and kind of handicapping how important that is to the protocol's infinite future. So I think it's a solvable problem. I'm not 100% convinced we'll have stable qubits anytime in my lifetime, but it's very much worth watching, like all things.
Is it fair to say that there will always be sort of an arms race here among all the crypto protocols, in the sense that there's going to be competing technologies that are trying to hack or exploit these protocols? And you have this arms race, right, where the protocol has to stay ahead of whatever the technology is that's trying to disrupt it. Will that ever go away? Because I just think, again, society progresses, technology is going to continue to get better. We can talk about what the time frame is for any particular risk, but isn't it the case that the protocol will always have to stay a step ahead?
In general, yes. Though, I mean, if quantum is the biggest risk, to a protocol staying ahead, that's a pretty high bar in terms of risk. I mean, I don't see any near-term technologies that have the ability to, hack crypto absent having that much computing power, and that's a pretty incredible amount of computing power to have to break the cryptographic algorithms. I think the bigger risk to crypto is more the human behavior, behind it. When you run a decentralized system and you empower people to manage the plumbing of their own finances in a lot of ways, then you introduce more human error into the system. And so this hybrid model, stuff that we do, putting stuff into an ETF wrapper, allows people to get the benefit of the decentralization without necessarily taking as much of the risk of managing their own keys and managing their own, various access points, custody, stuff like that. So, yeah, it's always, all systems are always going to be, anything of value is always going to be under threat. The question is which way is it coming from? And I think in crypto, it's really more of the human side of it still than it is, the technology coming to hack it.
Well, again, if humans can create something, they can destroy it. But I think it just gets down
Yeah.
into, what are the percentage chances of that happening? What are the probabilities? And that's what you have to understand. Some of them are minuscule, whereas some others may be, more probable.
I mean, the Google researchers were trying to put a 10% chance um, you know, uh, of quantum power capable of breaking Bitcoin within 10 years. I find that to be extremely high. I think that, again, the closer you are to a particular technology, perhaps the more you overestimate it. And in this situation, I think that in the broader scheme of things, I would put that below a single digit, for a longer period of time. Not zero though. And so by it not being zero, that makes it important, but 10% would be, outrageous. And I think you see this debate happening in the AI community. There's obviously a lot of worry about AGI and kind of the impact of what that will be. And I find that the closer the people are to the actual projects, the higher probability they put on. You can say, well, they're so close, they should know better. But I think in reality, it's different. I think when you are too close to something, you tend to overestimate it.
If it's a risk disclosure in spot crypto ETF prospectuses, there's at least some chance for it, which quantum computing is noted in all of the prospectuses. But Bill, just a few minutes left here. Whether we're talking Bitcoin or crypto assets more broadly, I'd love to close here by having you offer some thoughts on how investors and advisors might think about allocating to crypto in a portfolio. And obviously, it's still very early in the space. As you mentioned earlier, there's still a lot of education ongoing. But I know that you have conversations with all types of different investors, advisors, et cetera. What are you telling them in terms of how to think about crypto in a portfolio? And I thought we did a good job of covering Bitcoin there and how you view the world. I might offer many other crypto assets are much more akin to, say, VC investments, or they do look much more like those high beta tech stocks. But how do you think about this overall in terms of portfolio allocation?
Yeah, no, I think that's an extremely important point to bring up in this entire conversation because, like I said earlier, the level of education around the space still needs to go up, dramatically, especially for advisors and investors. At the very least, people should very much be looking at whether or not they should be in the space at all. And I would argue they should. And I think that one of the interesting things that we've discovered in this whole business line is that the level of interest of in crypto from the younger generation is just, extremely high. I mean, I think, looking at some of the statistics that we pulled out from the large banks that have been surveying their clients, we calculated that maybe almost 50% of high net worth investors between 21 and 43 have invested in crypto on their own, outside of, say, their advisor's portfolio, and another 39% of them are interested in, hearing more or making some sort of investment into the space. So I mean, you're looking close to 87% of high net worth individuals under, say, 40 or 40-ish are, crypto interested, and yet on the flip side of that, folks that are over 44, less than 1% of their portfolios are allocated to crypto. So there's this very large mismatch. And when you want to put some numbers around it, I mean, you're talking close to 60-ish trillion dollars of assets in the United States alone that will change hands over the next 20 years. And that's if you count, basically U.S. households with investable assets over $3 million. So that is a massive step change in investor thinking that's going to come over 10, 20 years towards the crypto space. And so there needs to be, a lot of thinking around how you you should allocate this into a portfolio. And like we just discussed, Bitcoin is certainly an important piece of that puzzle in terms of how you think about tail risk, long duration liability, fiscal dominance, and then to go to your next point about, okay, so then now what? How do I think about the rest of the crypto universe and what it's doing? And we try to tell people that it's a highly Darwinian universe. I mean, you have new entrants that come, dominate, and then get taken out, very quickly, outside of, Bitcoin. And so it's important to, be aware that you can't get too set on any of those positions, which, brings us back to the idea of indexing. I think, for folks who want to look at this just as an asset class, and we're not going to spend a tremendous amount of their time deep in the weeds in crypto trying to make sure that the particular name that they're interested in is going to be that Darwinian winner. Now, I think it's important to take an index approach. Let the market rebalance for you. Reduce your risk of behavioral bias. Essentially, don't get spooked by the volatility, such that the portfolio is able to adjust when you have these big drawdowns like we just saw in the last 6 months. We think that is just the right way to approach the market if you're not going to be a specialist in it, because there's still a lot to come still. I mean, we're still so early, in terms of its integration into markets. And we just talked about, hyperliquid and its dominance in the perpetual market. I mean, that was just an unheard of concept, I'm not sure exactly, but I would say like a year or two ago, right? I mean, in investing circles, I mean, that's like a blip in the market. So yeah, I mean, to your point, I think it's still extremely highly speculative. And so, unless you're going to do the work, I think you should let, the index do the work for you on the asset class level.
I think a number of excellent points there. I'll just note the generational wealth transfer that you mentioned. I agree. I think this is massive because the way I would think about this over the next 2 decades or so, you mentioned the 60 trillion figure. I've seen figures as high as $100 trillion in terms of baby boomers passing down
Mm-hmm.
their wealth. And you have to think about that both on the impact. I would say if you're a financial advisor, being able to serve that younger generation who, as you noted, they are more crypto fluent. They're bigger believers in crypto overall. Are you set up to serve that clientele, but also just the space in general that you are going to have younger investors who are going to be inheriting this wealth and they are going to be looking to allocate to crypto. And then to your point, okay, well, if you're going to allocate to crypto, how best to do it? I agree on the index-based approach. I'm very bullish on that. We've seen the success that's had on the traditional equity side, traditional fixed income. I think we could expand that to real estate, commodities, et cetera. I know, as you mentioned earlier, you call crypto the fifth asset class. Along with those, if you want to get exposure to that fifth asset class, indexing makes a lot of sense. So it is still early. None of us have a crystal ball, but I continue to say, maybe it's a little cliche, this isn't going anywhere. And you talked earlier just about the building that's taking place between stable coins and tokenization. We think about the infrastructure of the financial markets starting to move towards the crypto rails. There's a lot going on here that I think if you're interested and you have the right risk tolerance, I don't know that you want to be on the sidelines for it.
Yeah, I think if you put this in the form of kind of historical analogy, and I'm glad you brought up kind of those other asset classes, and if you've been around long enough, you probably have lived through maybe one or two of these kind of emerging asset classes coming, and you can really see the difference in thinking kind of pre and post the emergence of any particular thing. I mean, I know I lived through kind of the foundation of the commodity cycle, in the 2000s. I mean, commodities already were a tradable asset maybe before that, but for people who were pre-REIT or post-REIT, the idea of putting real estate into a kind of an equitized product just seemed like it's insane. What do you mean we were going to create a portfolio of real estate equities and trade them on the market? I mean, you buy apartments to live in, or you're a landlord. I mean, it just seemed like you couldn't even imagine the concept of it. And yet now it's just a staple of investment portfolios. Or, the same went for commodities. I mean, these were things that companies bought to put into their industrial systems. Like, why would I own oil? How could I own oil? This is crazy, right? And then the same goes for crypto. I mean, a lot of what people think is crazy, turns out to be very much a useful tool, in our kind of human financial economy. So, if that's true, then what crypto is doing, and I think just to kind of cross-reference earlier part of the DAS conversation is, less debate, more execution. I mean, if people are executing real, just bread and butter daily workflows in their financial system on crypto rails, then that crypto's kind of crossed into that realm now where it truly is become that asset class. I mean, we can kind of tick off a few of the things that you need to see, but I think we're seeing them. I mean, market size now, is no longer just niche. I mean, institutions can put real money behind those markets and know that, they're not going to get sized out. You can count on custody and settlement. You've now seen major custody institutions form, whether it's Coinbase, Anchorage, you name some of the bigger players that have gotten, banking licenses in the United States to custody assets. You're seeing settlement, rails that are much more robust, transparent pricing. Back even 5 years ago, you'd have Bitcoin, on 60 different markets, and you couldn't even tell what the actual price of it was. Now you can rely on a much more transparent pricing system, and then you're getting regulatory clarity. I mean, it's been a while, and still a lot to go, but the SEC moving in has also been a big part of that. And I would call the proof is in kind of two metrics, which is the recoveries. You start to see a recovery. So anything that's just speculative bubble that's a one and done will tend to go up tremendously and then crash forever. And you don't see tulips trading again. In any meaningful way, despite having a couple hundred years of chances to come back. And then you see the volatility come down. Every major cycle has a lower vol. And I think Bitcoin having lower vol over many cycles is starting to tell you that it's established itself as an asset class. And I think when you put all those together, you start to see the mosaic of it, matching some of the other stuff you had before. So I don't think you can ignore it. I just think you have to approach it cautiously. I mean, allocations should be in the single digit range for people, and then I think they should start from there and get your comfort level, and then just decide how you want to approach it on one horizon.
Well, Bill, I think that's the perfect spot to end our conversation. Really enjoyed hearing your perspective on the crypto markets. Enjoyed seeing you a few weeks ago in Vegas as well, but I appreciate you taking the time this week. Thank you.
Yeah, thank you, Nate. I appreciate the chance to be on the show.
That was Bill Birmingham, Managing Director at Osprey Funds. Thank you for listening to or watching Crypto Prime. As always, you can stay up to date on all of my latest guests by visiting CryptoPrimePodcast.com. See you again next week.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. Some guests appearing on this program may also be financial sponsors of Crypto Prime. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.